GDP and the economic cycle. GDP stands for Gross Domestic Product and is the money value of the output of everything produced in an economy in a year. Now there's also other measurements that you can use, such as GNP, Gross National Product, or national income. There are slight differences in the value of these numbers, but we'll stick with GDP for this particular video. Now in the UK you're looking at a number of about £1.4 trillion of output produced in the economy. And we're looking at the output of the primary sector, that's farming and quarrying and fishing, which is relatively small. The output of manufacturing and construction, which is secondary output, and then tertiary output, which is the service sector, retail, banking, insurance, etc. So what governments would like is for this GDP figure to go up every year, because if it does, you're expanding the income of the economy, and then you get all the benefits that hopefully come with that. And so this diagram here, the economic cycle, shows GDP growth over a period of time. And imagine it being 20 to 30 years or so. So we've got GDP on the vertical axis, time on the horizontal, and this straight black line is the increase in growth over a period of time. It's long-term average growth. And for the UK, we're looking at around about 2.5% a year or so over 30 years. However, every year the economy doesn't grow at 2.5%. Sometimes it grows by more than that, sometimes it grows by less than that. So when the economy is growing well, you're looking at an economy where consumers are out spending, businesses are doing well, businesses are spending money on investment, maybe the UK's exporting a lot of stuff abroad. And that would be marked when this wavy line is above the average growth rate. That's when the economy is doing well, and perhaps when it's in a bit of a boom. Equally, you can have occasions when the economy isn't doing quite so well, when there's a bit of an economic slowdown. And in that situation, people would be cutting back on their spending, shops wouldn't be doing so well, maybe you've got people who are gradually becoming unemployed, and increasingly you get more unemployment in the economy. That's an economic slowdown, and that's when the wavy line is below the long-term average growth rate. Now, that doesn't necessarily mean we're in recession when we're below the average long-term growth rate, because a recession has a very specific definition, and that is 2 quarters of negative growth. So 2 quarters being 2 3-month periods. So basically 6 months of negative growth. So you could, for example, be below the average but still be growing at about 0.5 or 1%, but it would be quite slow for the economy, and the economy could do with growing a little bit quicker than that. So what we've got on this diagram is, imagine here this little dip below the line. This could be the period between 1980 and 82, when we had an economic slowdown. In fact, it was a recession, and the economy wasn't doing too well at all, and we had large amounts of unemployment, and consumer spending wasn't particularly high. What then tends to happen, though, for various reasons, is the economy eventually does start growing again, consumer confidence rises, people start getting back into work, and we go into an upturn, and that might then lead to a boom, and the economy might grow at say 4 or 5%. It might be higher than its average long-term growth rate, as we did in the late 80s. And then again, for various reasons, the economy may slow down, and you go back into an economic slowdown. Now, there are various causes of booms in the economy and slowdowns in the economy, and I don't particularly want to go into those now, but they are related to economic activity, to consumer confidence, to employment levels, to government levels of tax, to changes in interest rates. All of these things have an impact on the economic cycle, and as an economist, as you get more confident, you can start analysing and evaluating the causes and consequences of changes in the economic cycle. Between the years of 2009 and 2012, you're looking at an economic slowdown. Part of that, many countries were indeed in recession, and there were various causes and consequences of that, and hopefully there's various ways in which economists and governments can think about trying to get out of economic slowdowns of that type. But at its most basic level, the economic cycle diagram is very, very simple.